Hello everyone, this is Dr.Mihir Shah once again with another video. In this video we are going to solve April 2024 university question paper under the subject Security Analysis and Portfolio Management, also known as SAPM. In this video we are going to take up all the practical problem sum that had appeared in the paper and try to solve them in the most simplest manner. So chalo, let us see how to solve each and every problem sums in this particular question paper.
Okay, now the first question is question number 2C. Let us see how to solve that. It is given that the rate of return for stock Bright and Light Limited under different state of economy are given. So they give you return of Bright and Light. Calculate the expected rate of return, standard deviation of return on stock. And as an investor, which company should you prefer for investment? So we'll start solving it. First step, we will note down this is for company Bright. So we'll write this for Bright Limited. Okay, we have economic condition. Okay, they have given you the probability, they have given you the return. We need to find expected return. Okay, the next will be R minus expected return. Then we'll have R minus expected return the whole square, and then P into R minus ER the whole square. Okay, chalo. Economic condition mein we have high growth, we have low growth, we have stagnation, and we have recession. The probabilities are 0.2, 0.3, 0.4 and 0.1. The returns are given as 13%, 10%, 7% and 4%. We need to first find the expected return. So expected return, we need to multiply P into R. So 13 into 0.2, which is 2.6. 10 into 0.3 is 3. 7 into 0.4 is 2.8. 4 into 0.1 is 0.4. Now we add up everything, plus 2.8 plus 3 plus 2.6. We get 8.8 as the value. So this is nothing but an expected return. So first answer, expected return equals to 8.8%. Okay, that's the first answer. Okay, next we need to now find R minus ER. So R rate minus expected return. So it will become 13 minus 8.8, which is 4.2. The square of that 17.64 into the probability. So 0.2. So we got this as 3.5. Okay, we'll make it as 5.3. Okay. Same way, next 10 minus 8.8. It is 1.2. The square of that 1.44 into the probability 0.3. So that becomes 0.43. Next 7 minus 8.8 is negative 1.8. The square of that is 3.24 into the probability 0.4. Which comes to 1.296 or 1.30 when we round up. Next, return is 4 minus 8.8. It is negative 4.8. The square of that 23.04 into the probability of 0.1. So I get this value as 2.30. We add up, this is nothing but a variance. So 3.53 plus 0.43 plus 1.3 plus 2.3. So we get the value as 7.56. So now standard deviation is the root of variance, which is P into R minus ER the whole square. So that is nothing but root of 7.56. We found that comes to 2.749 to 75. So our standard deviation of Bright Limited is 2.75. Expected return is 8.8%. Same way, now we'll start with the other one. After Bright we have Light Limited. Okay, based on the same logic, we have economic condition. Okay, probability is given, returns are given, expected return, then we have r minus expected return, the square of r minus expected return, and then probability into expected return the whole square ka. Okay, we have high growth, low, stagnation, and recession. Probability is 0.2, 0.3, 0.4 and 0.1. The returns are 11, 12, 5 and 7. Chalo, let us multiply them. 11 into 0.2, that's 2.2. 12 into 0.3, 3.6. 5 into 0.4 is 2, and 7 into 0.1 is 0.7. We add up all this, plus 2 plus 3.6 plus 2.2, we get the value as 8.5. Therefore, number 1, expected return is 8.5%. Now R minus ER, so 11 minus 8.5 is 2.5. The square of that 6.25 into the probability 0.2, that is 1.25. Next is 12 minus 8.5, which is 3.5. The square of that is 12.25 into 0.3, which comes to 3.675, or 68 will make it as. Next we have 5, so that is 5 minus 8.5, which comes to negative 3.5. The square will be 12.25 into 0.4, which comes to 4.9. Okay, next is 7 minus 8.5, which comes to negative 1.5. The square of that is 2.25. Okay, and into 0.1, which is 0.22, so make it 0.23. We add up all those values, so 1.25 plus 3.68 plus 4.9 plus 0.23, we get the value as 10.06. Second, we need to find the standard deviation, so it is the root of p into r minus expected return the whole square, which is the root of 10.06. The square root of that comes to 3.17. So that's the answer. We have found the expected return and standard deviation for both the companies. Now they're asking us to find, stating that as an investor, which company would you prefer? Okay, so now look here. Expected return point of view may Bright Limited has a higher expected return, and in standard deviation point may, okay, Bright Limited has the lowest risk. So since expected return is higher and standard deviation, that is the risk, is lower. Okay, since the expected return is higher and the standard deviation, okay, since expected return is higher and risk is lower of Bright Limited, it is advisable to invest in Bright Limited. Okay, so this is how I like to solve question number 2C. This was carrying 15 marks. Okay, chalo. Now let us see the next sum which was there available. That was question number 3C. Okay, the next question 3C reads as, following information is available relating to Bay Limited and Day Limited. They're giving you equity, preference, debenture, profit after tax, proposed dividend, market price, current asset, quick asset, current liability, and they're asking you to find various ratios. So chalo, let us see how to solve the sum. The first ratio they've asked us to find is earning per share. So I've written the formula here. Earning per share is equal to profit after tax minus preference dividend into number of equity shares. Now, for Bay Limited, profit after tax is 100 lakhs. So I'm writing 100 minus preference dividend. Preference ka value was 160. into the dividend, the preference dividend of 12%, so that become 19.2 divided by the number of equity shares. Now 400 of 10 each, so 40. So we will divide that, so it comes to 100 minus 19.2 divided by 100 minus 19.2 divided by 40, so it comes to 2.02. Same way for day, the profit after tax is 140 minus preference shares were of 200 into 12%, which comes to 24. Okay, 500 divided by 10, 50. So 140 minus 24 divided by 50, 2.32. Next ratio, PE ratio. Formula is market price. Market price given is 400 upon, and for this one it is 560 upon earning per share 2.02 and 2.32. Chalo, we will apply, divide 400 divided by 2.02, which comes to 198, and 560 divided by 2.32, it comes to 241. Next, dividend payout. It is given dividend upon earning per share. Sorry, not earning per share, earnings. Okay, that is net profit after tax, the total earning. Dividend is proposed dividend. It is given here 70. For the other one, it is 80. Upon the earnings, earnings is profit after tax, so 100. Here it is 140 into 100. So we apply 70 divided by 100 into 100 comes to dividend payout is 70%. And here 80 divided by 140 into 100, so it is 57%. Debt equity, debt fund, debentures or debt funds, so 100 divided by equity funds. Equity funds are equity share capital of 400. Okay, and in that case it will be 140 is our debentures upon 500. So 100. So 100 divided by 400 is 0.25, and 140 divided by 500 is 0.28. Okay, remember this was the seventh ratio that they had asked. Okay, I had already written it down, so I will rechange the number. This is the seventh one. So these were the first four ratios in that sum. Now let us see the other ratios. There were three more ratios. Next one was return of equity or return on equity shares. Formula is profit after tax. Now profit after tax again is 100. Here it was 140. Okay, this is into 100 upon equity capital. Equity capital is 400, and here it is 500. So 100 divided by 400 into 100, it comes to 25%. 140 divided by 500 into 100 will come to 28%. Current ratio is current asset upon current liability. So that was 160 upon 125 and 180 upon 135. So 160 divided by 125 is 1.28, and 180 divided by 135 is 1.33. Quick ratio is quick asset, that is 140 upon 125 and 150 upon 135. So 140 divided by 125 is 1.12, and here it is 150 divided by 135 is 1.11. Okay, so this is how you all had to solve the sum based on ratio analysis. You just have to learn the formula and thereafter just substitute whatever values they are given in the question. Okay, so I hope everyone have understood that. So this was question number 3C, which was again 15 mark. Okay, so now let us see what are the next question. Okay, now the next question is question number 4A. The details of 3 portfolios are given below. They are giving you portfolio average return, beta, standard deviation. Compare this portfolio on performance using Sharpe's and Trenor's measure and rank the portfolio, and the risk-free return is 9%. Okay, chalo. So we'll start with first Sharpe's measure. Formula is return minus risk-free return upon standard deviation. Okay, now we have 3 companies, 3 portfolio. So first portfolio TH Limited. The returns are 13 minus risk-free return. Risk-free is 9 divided by standard deviation. Standard deviation is 0.25. Thirteen minus 9.25. Twelve minus 9 divided by 0.2. Again same, return minus risk-free return divided by standard deviation, that comes to 15%. Next is RH Limited. Again return is 11 minus risk-free divided by beta 0.25. So 11 minus 9 divided by 0.25. And last is market index. 11 divided by 9 divided by 0.2. Which is 10%. Okay, so this is how you all had to solve the sum. Now we have to rank them. So rank wise, the highest rank is TH Limited, so rank number 1. So I'll write here rank. Then is 15%, so that's rank 2, 10 rank 3, and 8 is rank number 4. So same way now we will start with, okay, you all can go through till that time. I'll note down the formula, Trenor's measure. Formula similar, it's R minus RF but divided by beta. Okay, that's the only difference. So chalo, TH Limited, the numerator will remain same, so it is 13 minus 9 divided by beta, that is 1.25. For KH, it will be 12 minus 9 divided by the beta 0.75. For RH Limited, it will be 11 minus 9 divided by 1.10. And for market index, 11 minus 9 divided by 1.0, yeah, 1. Okay, so let us find out the values of each now. So first is 13 minus 9 divided by 1.25, it comes to 3.2. Next, 12 minus 9 divided by 0.75, which comes to 4%. 11 minus 9 divided by 1.1, which comes to 1.81. And 11 minus 9 divided by 1, which comes to 2%. Okay, now from this we need to rank them. So rank 1 will be 4%, rank 2, rank 3, and rank 4. Okay, so this is how you all had to solve this particular sum. You all can open both the Sharpe's measure and Trenor's measure. Okay, this is question number 4A. So you all can go through it once. Okay, now the next question under same question number 4B was, the government of India bonds of rupees 1000 each has a coupon rate of 9% and maturity period of 7%. If the current market price is 1200, find the YTM, that is yield to maturity. So first we'll note down the formula. So I'll write here YTM is equal to interest plus face value minus market value divided by number, the whole thing upon face value plus market value divided by 2 into 100. Okay, now I'll just note down the data first here. Okay, the interest here, the interest was given the question 9%, so 9% of 1000. So on the calculator, 1000 into 9% is 90. The face value is given as here 1000. The current market value is given here as 1200. The number of year is given as 7 years. So I have the data with me, so now we can just apply into the formula. Interest, that is 90 plus face value minus the market value divided by the number of years, the whole thing face value plus market value divided by 2 into 100. So that's 1000 minus 1200 divided by 7 plus 90 . Okay, so I minus divided and I added 90 to it. So I got the value as 61.42 divided by 1000 plus 1200 divided by 2, that's 1100 into 100. So 61.42 divided by 1100 into 100, which comes to 5.58%. Okay, so our yield to maturity is 5.58%. So this is how you'll have to solve this particular sum, question number 4B. So you can go through it once. Okay, the next question, question number 5A. The return of Tata Limited are given below for 5 years with their market return. You are required to compute the beta. Okay, so they're giving you 5 years ka data and they're asking you to find the beta. So we note down 5 years, 1, 2, 3. The returns of RS are 40. RS is the market, the security return, and RM is the market return. Okay, 40, 36, 32, 42, 48, 40, 34, 30, 48 and 52. Okay, first we know now the first the steps are very important. Okay, now we need to get the total of this 40 plus 36 plus 32 plus 42 plus 48, that is 198. 40 plus 34 plus 30 plus 48 plus 52 is 204. Now we need RS. Once you get the total, the bar, the averages. So 198 divided by 5 and 204 divided by 5. We need RS bar and RM bar. So 198 divided by 5 is 39.6 and 204 divided by 5 is 40.8. The next is RS minus RS bar. So RS 40 minus 39.6 is, I'll write here, 40 minus 39.6 is 0.4. Next is 36 minus 39.6 is negative 3.6. Next, 32 minus 39.6 is minus 7.6. 42 minus 39.6 is 2.4. 48 minus 39.6 is 8.4. we add up 0.4 plus 2. First I'm adding up all the positive values. Okay, wait. I don't require any of the total. I only need the last two columns total, so we keep it as it is only. Next 40 minus now RM bar, so that is 40.8. So 40 minus 40.8, negative 0.8. 34 minus 40.8 is negative 6.8. 30 minus 40.8 is negative 10.8. 48 minus 40.8 is 7.2. 52 minus 40.8 is 11.2. Chalo. Now these two का multiplication, 0.4 into 0.8, 0.32, but it is negative, so it will become negative 0.32. 3.6 into 6.8 is 20, minus and minus will become plus, so it will become 24.48 positive. 7.6 into 10.8, it will become positive 82.08. 2.4 into 7.2 is 17.28. 8.4 into 11.2 is 94.08. Okay, big numbers. Now once you get this, we will total it up. I need this column ka total. So 24.48 plus 82.08 plus 17.28 plus 94.08 minus 0.32, so that becomes 217.6. And lastly the square, so 0.8 ka square is 0.64. 6.8 का square is 46.24. 10.8 का square is 116.64. 7.2 का square is 51.84 and 11.2 का square is 125.44. We need to add up 0.64 plus 46.24 plus 116.64 plus 51.84 plus 125.44. The total comes to 340.8. Once we have got this, now we'll just apply into our major formulas. We need to first find covariance of R minus R in R1, RS, RM. So that is 217.6 divided by n minus 1. So n was 5. So 5 minus 1 is 4. So 217.6 divided by 4, I get the value as 54.4. Standard deviation square m, that is the last column ka total, divided by 5 minus 1 is 4. So 340.8 divided by 4 is 85.2. Okay, lastly covariance, so that is 54.4 divided by 85.2, which comes to 0.64. So my beta is 0.64. Okay, so this is how you all had to solve this particular sum, which was based on finding the covariance and beta. Okay, basically they only asked you to find beta, so covariance comes with beta. Chalo, you all can go through it once. Now one last question is available to be solved in this particular paper. We will start with that then. Okay, I'll read the question. Calculate the operating leverage, financial leverage and combined leverage from the following data. Output is given to us. Sales in rupees, variable, fixed, interest and income tax are given. So in order to solve this, I'll just write here, this is XI limited and YI limited. Format is sales less variable cost will give you contribution, less fixed cost will give you earning before interest and tax, less interest will give you earning before tax, less tax will give you earning after tax. Okay, that's the income statement that we require. Now we'll write down what all things have been given to us. They are giving you sales 20 lakhs and 8 lakhs. For variable cost, they give variable cost per unit is 20 rupees and there are 15,000 units. So 15,000 into 20, that's 3 lakhs. And for the other one, it is 48 and number of units are 5,000. So that will become 2,40,000. So 20 minus 3 lakhs is 17 lakhs. Fixed cost is 10,44,000 given. For the other one, it is 2,80,000. So 17 lakh minus 10,44,000 is 6,56,000. And the other one, 5,60,000 minus 2,80,000 is 2,80,000. Interest, they said interest is going to be, it's given directly 1,80,000 and 1,60,000. So 6,56,000 minus 1,80,000, we get the value as 4,76,000. Of that we have to remove 30% income tax, 142,800. We minus that, we get 3,33,200. Same way, 2,80,000 minus 1,60,000. Of that 30% tax, 3,60,000. 36,000. We minus, we get 84,000. Okay, once the income statement is done, we'll start with the formula. This is XI limited and this is YI limited. First they want us to find is operating leverage. Operating leverage ka formula is contribution upon EBIT. So we'll write contribution 17 lakhs upon EBIT is 6,56,000. यहाँ पे it is 5,60,000. $6,56,000. So we divide this, we get the answer as divided by 2,80,000, which is 2. Okay, same way financial leverage. Financial leverage ka formula is EBIT upon EBT. EBIT is 6,56,000. EBT is 4,76,000. 2,80,000, 1,20,000. We divide 656,000 divided by 4,76,000. So I get the value of 1.38. 2,80,000 divided by 1,20,000. We get the value as 2.33. Lastly, combined leverage, which is nothing but operating leverage into financial leverage. 2.59 into 1.38. And here 2 into 2.33. 2.59 into 1.38, 3.57, and here 2.33, 4.66. Okay, this is how you all had to solve this particular sum. So chalo, with this we were able to solve the entire paper of April 2024. So I hope everyone have understood it. With that, we will be ending this video here. Thank you.